G'day YouTube, just a quick video on the benefits of starting young. Starting young in investing. Now, I spoke about this in my last video. I spoke about index funds, real estate, mutual funds. Now I wanted to just show you the power of that, what that looks like in actual dollar terms. So in this very chart here you can see, now this is an index fund. Now index funds, you can expect a net return, that's after expenses, of between 7 and 8%, and that number's been good literally forever, for like 100 years. It was whenever index funds were. They've back tested it back to hundreds of years, and basically your index funds, mutual funds are generally good for that sort of a return over the long term. So I call it like investing like a retard, or investing like a moron, but it's really not moronic. It's actually quite smart. But this chart is to show you the benefits of investing young versus starting later. So in this chart here, you've got two people. So on the left, you've got Lachlan and you've got Sam on the right. So Lachlan invests $10,000 per year into an index fund for 10 years, and then he doesn't invest another cent for the rest of his life till he's 35. Now, Sam, and the second side of the table, he starts at the year 6, so there's only 5 years difference there, but he invests $10,000 for the rest of his life. Now you can see the balance of what these two accounts have after 30 plus years. Lachlan in number 1 has only invested $100,000. It's seen at the bottom there. His balance is $17.99, 1.799450 million, versus Sam, who started at so he started later in the 6th year. He skipped those first 5 years, and he ended up investing 3 times the amount of money for triple, quadruple the length of time, and he ended up with less money due to the early effects of the compounding interest at that time. So I'm just trying to explain the benefits of investing young. This is more applying to index funds, but it applies to everything, because compound interest is like the 8th wonder of the world. I think Warren Buffett or one of them people say that. So here's another one, like the power saved $1,000 for 10 years from 25 to 34. So he's then the guy at the bottom started at 35, saved $1,000 for 30 years starting at 35, and you can see the differences there, the benefits of starting young. So this is just another chart, another graphical chart. If you're a visual learner, these are probably helpful. So again, we've got a guy saving $1,000 a year for 10 years from a young age versus saving $1,000 a year for 30 years. So he's saving, triple the amount of money for that time, and he's clearly in front by, So we can see that, the guy that did it for 10 years and then stopped. So the guy at the top's got a $157,000 balance after investing $1,000 for 10 years from an earlier age. The guy at the bottom has a $122,000, 346 balance for saving 30 years and $1,000. So you can see he's saved, 30 times what this initial guy saved, but he started later, so he doesn't get the benefit of that early compounding. And that compounding is compounding in itself. So I'm just trying to show you the benefits of starting young. Now this is more applicable to index funds, but it does apply to real estate, pretty much any other kind of asset, even business assets. But the benefits of starting when you're 20, ideally 20, 25, later than that you're having to end up doing what this second guy is doing. I probably should explain also index funds, what they are. Now index funds are like a makeup of the best stocks and companies, real estate, REITs, that's real estate investment trusts, mining companies, all the biggest and best companies generally are in the popular index funds. So you're basically tracking the market and you're getting a 7 to 8% return net over the long term. Now there's also taxation benefits with that, deductions, and you're getting that dividend every quarter, and that dividend is going up in relation to the price of those stocks going up. They do cut dividends and things like that, but there's, that some of them are set up to be a little bit defensive. You can choose your level of risk. Obviously, if you're a bit younger, you probably want to choose a higher level of risk, because you can afford to recover a bit more when you're younger. When you're older, you probably want to dial it back a little bit. Usually these funds have separate settings within the funds that allow you to specify whether you want high, medium or low risk, or just simply basically sitting in cash in an offset account is even, or in an account, is an option. Now this chart is again, it's an extreme example, but this is Warren Buffett. He's one of the most successful investors ever in the history of the world. So he's Berkshire Hathaway is his company. It's privately listed now, which means it only takes on accredited investors, that sort of thing. But you can see what he's done. He started at $5,000, $6,000, $10,000, $20,000, $40,000, 1 million, 1.4, 2.4, and then you can see the power of the compounding here at the end. And now we're obviously getting into the ridiculous area. But this is a business-centric stock investing sort of way of looking at it. So obviously if you want to go into individual trading or running a business, that's a much harder, more stressful thing to do. But the returns are going to be way higher than anything else if you're good at that. Now the learning curve for that is a lot more than, say, real estate, which is why I tend to lean towards real estate and index funds, depending on your skill set, as I've discussed in an earlier video. Yeah, just using Warren Buffett as an example anyway, that's what he's done with his stock trading in Berkshire Hathaway. This is an extreme example of an inflation or a hyperinflation. This is the Weimar hyperinflation, what occurred in the Weimar Republic. Now there's other examples of this. There's Zimbabwe, there's Argentina, this happens regularly all over the world, even in developed economies it can happen. So with COVID, with the money printing and the stimulus, this is potentially the scenario we could see ourselves in. Now, the reason you want assets and you want to be asset backed is because you will actually track this no matter how ridiculous these numbers get. It doesn't make any sense to you, but if you look at this was the roaring 20s from 1920 to, they considered that the roaring 20s, the first few years of the 20s. And then in Weimar particularly, they had the Weimar Republic, which was obviously an extreme case, which was Germany started just printing dollars where they didn't have the value of gold to back up those dollars, and they rapidly lost value. Now we're in a situation like that now, where the deficit spending, stimulus, government's printing so much money that this is a potential outcome for all countries, not just Germany or any of these less economically responsible countries. This is a potential reality for us in the future, whereas where you can't afford a loaf of bread. So here's some pictures of the money, like people with wheelbarrows full of money. This can actually happen. Now today it would be digital, so it would be the digital version of this. Your account would be increasing at some ridiculous rate. Your rents would be going up at some ridiculous rate. And that is the reason alone you need to be asset backed. Now assets are, in my view, the easiest form of assets is real estate and index funds are my two go, because they're nice and easy. They're very easy to understand. There is a learning curve. It's not as big of a learning curve as you think, but there is a learning curve. So don't be naive enough to think, I know how to get a mortgage, I know how to buy a house. You need to be able to do a bit of research on that, buy the right house in the right area. Don't overcommit yourself with debt, just sensible use of debt. The other thing I'll say about debt in a hyperinflation is debt, even though there's interest charged on it. So say you've got a $300,000 mortgage on a $600,000 house, just to use round numbers, and we have a hyperinflation, for instance. Now that $600,000 house could go to $5 million in a couple of years. You can see the chart there. It went from like 10 marks to, what is that, 1 trillion, I don't know, 1 trillion, I'm not sure what it is. It did that in the space of 2 years. So this is the cost of goods and services. So at the end stage of this, restaurants are updating their prices bi-daily, like 3 times, 4 times a daily. Then they're doing it hourly, then they might even be doing it every half hour. So this is the kind of situation, getting people to pay their restaurant bills before they order the food, because by the time the food comes out, it's worth 3 times the price, and they couldn't afford to pay for it. So this is the sort of thing happens in a really extreme scenario. So just going back to this is an amortization schedule for a mortgage from a roughly $300,000 balance, and you can see where it crosses over there in about year 8, 7, 8. So what that is your mortgage being paid down over time. So in a hyperinflationary event, what's happening is the asset is going up in value a lot faster than you're paying down that loan. And your loan, while you are paying interest, you're actually not paying, you're just sitting there sort of treading water, but the asset value is going up at such a rate that what you'll be able to do is pay down the asset with the hyperinflated funny money in a matter of weeks, if not days. So in this sort of an environment, which a lot of people are saying, everyone can see prices are going up, this is the reality of the situation. If you have debt on real estate, as I said, that's my specialty. Debt on real estate is your friend in this sort of scenario, because it ends up being paid for in the hyperinflated funny money. Anyway, I'm going to end it there. So the amortization schedule, need to know what that is. You need to know what inflation, hyperinflation is. Read Rich Dad, Poor Dad, the book review I did previously. And also, what was the other thing? There was one thing right back at the start of the video. The benefits of starting young. So if you start at 20 versus starting 30, I've put some charts up there to show you the benefits of starting young. And yeah, start young. That's all I've got to say. You start young with very little amount of effort for 10 years and then do nothing. You literally don't have to put another dollar into it. The compound interest, you know, there's two types of people: people who pay interest or people who have interest paid to them. So compound interest, the eighth wonder of the world, so understand it. If you can't afford real estate, can't get a deposit, index funds is a great place to start, because you're going to get your 7 to 8% net return, dollar cost averaging. That's putting the same amount of money every week into an index fund, regardless of your financial circumstances. Just keep putting it in. As I said, investing like a moron. It's not moronic, it's actually really smart. Your interest rates on your savings account are like, they're negative because you're getting taxed on that interest. So your stock, your index fund, dollar cost averaging, you're actually getting tax credits as well as dividends. So there's tax benefits on the inside of that. When you file your tax return, you put a statement in, and there is tax that will come back to you, or tax that you won't pay, and you'll get that part of your income tax back. Anyway, I hope I've explained some things. See you next time. One more thing, I will put links to Raise, Spaceship in my description, so you can use them. Those are index funds that I recommend, and they're a nice, easy way to start. You can set up the dollar cost averaging direct deposit straight out of your bank, so you don't even see it. It can be $10 a week, it can be $50 a week, it can be $5,000 a week. You set it to whatever it is. If you're a 20-year-old, great, you've worked this stuff out, back check this, Google it, look it up. Don't rely on what I'm saying, look it up on Google. I'll put the links to Spaceship. I think if you put in $10, I think you get free $10 if you just sign up using these links. Spaceship's the same. There is some benefit for sign up. It's free money basically. And then you can set that up. If you want to diversify between the two, Raise and Spaceship are a good place to start because they're nice and easy. And then when you get a bit more experience, you want to start looking at something like Vanguard funds, really low cost index funds that you need a stock brokerage account and things like that. Raise and Spaceship are great starting points for maybe your first 10 years, but then you want to look to maybe a Vanguard fund for the long term. I mean, you can look at that from the get-go. That would be the better way to go. But Raise and Spaceship to dip your toes in the water. I'll put the links in the description. As I said, you get free money using those links. They put a little bit of money in your account when it's verified. And I'll see you in the next video. Here's just links and the invite code to Spaceship. It's spaceshipinvest.com.au, and Raise is also Raise Invest, R-A-I-Z, invest.com.au, and I believe you get $5 if you use those invite codes on those two apps. Your App Store or the Google Play Store both have them. Cheers.